Hello and welcome to the Summer 2021 Economic and Investment Outlook from Pearl Planning. I'm Melissa Joy, founder and financial planner at Pearl Planning, and I'm so pleased to be joined by Melissa Fradenburg, financial advisor, and Alexa Kane, financial planner. And today we are going to be covering a big agenda. There is a lot to talk about when it comes to investments and the economy. And so we're going to dive right in. We're going to be talking about the Fed, inflation, the economy, stocks and bonds, potential policies coming out of Washington, and what you should be thinking about and how you should be reacting to the world around us. So with that, I will just mention that we love having questions, but we have a slightly clunky question format because we need a record of all the questions that we receive. I ask that you send me an email at melissa@pearlplan.com. You can do it anytime during this call, and at the end, I'll gather those questions and we'll answer any. And you can always also feel free to email us after the call or give us a call if you want to talk about any of the specifics. And to remind you, we always are working in conjunction with Raymond James, who has a solid team of economists, portfolio analysts, and investment professionals. So in addition to our thoughts, we're kind of building upon the mountain of information that Raymond James provides. And they have navigated us through the pandemic, and we really feel confident and comfortable with where the information that they're providing for us going from here. So that input and insight is a very welcome additional resource that we're using in this conversation. So without further ado, I want to start by talking economy. And what I hear most often is, why the heck do you think that the economy is going to continue to perform? And that is a great question. It has been a year or now 2 years that in some cases defies logic. It's definitely unprecedented times. And we're fortunate to have some real-time indicators to understand what is going on when it comes to the economy. These are kind of the 6 cylinders that Raymond James loves for just-in-time information about how things are going. So some leading indicators, some favorite economic indicators that have really real-time information, because in so many cases, you kind of figure out what's going on after it's already happened in the world of economics. So we like these because there is more frequent data. So one of the really positive signs is that there continue to be record highs withholdings, which means that people are making money. When people are employed, they must be having rising wages because those withholdings for taxes are a good indicator that it comes out weekly. And while we'll talk in a moment about how impactful the jobless claims were in this recession. It was just the worst jobs recession that we've had, even though it was so short, only 2 months long. We will, the jobless claims are in good territory. So they're not as bad as they were, and they continue to be improving. One of the things that you probably know, and this is going to dovetail right into our conversation on inflation, which I think is one of the most popular or important things that everybody wants to talk about right now, is that manufacturing doesn't have a lot of supplies on hand. And so the new orders are running at a level above 50, which is definitely expansion territory, an indicator of what's to come, because of course, these are the parts that are going to fill the goods that are going to be sold down the road. And certainly there's been some supply chain disruptions. So that has not made everything as smooth and easy as it could be, but is also telling about the future. Motor vehicle sales, the only thing holding people back is both inventory and price. There definitely has been some the ongoing demand for new vehicles. The car lots don't have a lot of them on there, but still the sales of cars are the highest that they've been since 2005. Banks continue to be still, paying attention to underwriting details, but demand is picking up for borrowing. And then just generally the activity that you see on day-to-day people walking around, whether that's when I just picked up my lunch from the restaurant below us, the half full restaurant for a 1 p.m., which was empty for so long, or TSA screenings, things are really getting back to normal. And we'll talk a little bit more about why in a moment. So what is driving this growth? What is driving those numbers? Well, in a word, in the United States, at least, the US consumer is ready to go. They are ready to emerge from COVID times. I know that the Delta variant is a curveball that is going to certainly be in both headlines and in people's lives, continuing to be in people's lives through the summer and the fall. But the consumer is driving the economy. And when you look at economic growth, you see that more than 70% of that growth is coming from consumer spending on goods and services. And in fact, it's people are kind of, they've had enough stuff, so there's a lot of expenditures on services specifically. And in terms of Raymond James Sentiment Survey, 80% say that they are comfortable resuming normal activities, and the number one priority is to get out of Dodge, leave their specific area code, and go on vacation. So there's a lot of pent-up demand. We see that in prices. We'll talk about that a little bit more when it comes to inflation. But the drive for consumer spending, it's not just fan on money that people are spending. So there is excess disposable income that comes both from stimulus as well as working. Net worths and the investment returns are at record highs. There is ongoing confidence in terms of personal lives post-COVID. And there's a lot of pent-up demand. And this demand isn't going to be puttering out in 1 or 2 quarters. And we also have the improving conditions in the labor markets. So we had a really bad labor recession, but now we have the return to normalcy. We're not back to kind of where we started from, but it's looking a lot closer to that. So let's talk about 3 things that could be game changers moving forward. These are reasons why growth expectations continue to be revised higher, which is a big deal. So we are operating in an economy that may be one of the best years in terms of economic growth for the last 60 or 70 years, or second best. You have to go back to the 1950s to see a growth year like this. And why? Well, some of those factors that we were talking about are certainly consideration, and you're also coming off of such a low. So you had this enormously bad economy in the second quarter of and ongoing in 2020. And what we learned is that everything gets repriced off of that low. And so it's not a shock that the growth numbers are good, but economists continue to revise numbers, and they look like to be getting better and better. So you've got 6 million people that are returning to work. So new jobs coming back into the economy, that should increase consumer spending and to a tune of about $200 billion. Those are very big numbers to think about. Additionally, you have the inventories going back from just levels that are unsustainably low in terms of inventories in order to supply goods to the economy. So those things are going to need to continue to be ordered, and that's going to be pumping through the economy. And so that's another $150 billion of potential investment into the economy. Then you have stimulus and policy from Washington. So the child tax credit began this month. We could talk separately about your need to either take it or pay it back if you're in a complicated situation. But that's another $100 billion to consumers. And then Melissa will be talking later about the potential for an infrastructure bill, but I just was refreshing headlines to make sure that I didn't have any Fed announcement that I needed to be mentioned as I recorded this on Wednesday at 2 p.m. and noticed that there are some key Republicans that said they're willing to deal on infrastructure right now. So that could very well be something. It's definitely going to continue to be a headline, and it's somewhat tied to reemergence of the debt ceiling as being an issue. So be prepared for either drama or headlines or potentially a deal, and we'll always keep you posted about what's going on. Okay, so inflation is the number one thing that I know people want to talk about. They're seeing it in their lives. If you had planned a home improvement project pre-COVID and then are getting around to it this summer, you're thinking, why is it the cost of this project 30 to 50% higher. You can see that in travel. If you're looking for a rental car, they're difficult to find and you're going to be paying triple or more from what you expected to find. And certainly inflation is not a friend to a financial planner, a consumer, or a retiree. And so this is a really important discussion. And we may even need to be familiarizing ourselves with what inflation looks like, because we've had inflation that was really pretty low for a long period of time. You have to go quite a ways back to see inflation north of even 2.5%. And that's what I would focus on if you were looking on this page on the chart on the left. So this is a look at inflation going back for the last 10 years. And it's broken down into two components. So there's the things that are less sensitive to COVID, that don't have the supply chain disruptions, aren't tied to the US consumer. And those are in the dark blue. And then the light blue is things that are more COVID sensitive. So your hotel prices, your price of transportation, automobiles, et cetera. And one thing that surprised me when I looked at this chart was, inflation bounces around quite a bit. So both of them have had different numbers over time. These numbers are reported month to month. But you can see last year, let's look at 12 months back, 18 months back, there was just a real fall off in terms of inflation. And the light blue COVID sensitive was almost immeasurable in terms of their growth in price. In fact, there might have been some deflation there, or there's just no movement or activity. Then we look at the dark blue, it stayed pretty consistent. And now here we are in this range, and you can see in the yellow circle on the left-hand chart where we're just kind of sky high through the roof on COVID sensitive pricing. But I do think that variability may be a function of some of that supply chain issue, and that's what our chart in the middle discusses, as well as just coming off of these very abnormal, unnatural lows that were obviously created by a very real economic event and global pandemic event with COVID-19. So supply chain constraints, and even if you look at them price by price, the futures contracts for lumber, for example, were through the roof earlier this year and started to ease over the summer. You can see as a group, supply chain constraints seem to be getting more, there may be a tipping point. And you can also see on the back end how those constraints kind of disappeared when people quit ordering things. And so, I think we're going to have more of that variability and bouncing around. Economists like to use a fancy word, transitory, to say temporary. But that is a thesis that potentially, there could be more inflation than the 2% that we've kind of gotten used to, but less than sky high inflation. Typically, if you have inflation between 3 and 6%, it tends to be a positive indicator for stocks. We'll talk more about kind of our stock outlook as we go. Also, when you have very high inflation, the velocity of the money flowing from the government into the economy is higher, and you have an abnormally low velocity of money right now. Another indicator that inflation may not be a permanent, at least current issue. So all of these factors being taken in by the Fed, who is in the meeting as we speak. And some of the things that they're going to be thinking about, they often are very focused on employment. In fact, they've been expanding kind of their definition of employment to have more equitable consideration of less of different communities as well. And the chart on the left here is looking at the employment in recessions and recoveries. And if you're looking at that huge valley that kind of stands out, the dotted line relative to which one of these kids is doing his own thing, I would say, that is our most recent recession with COVID-19. So you just had unemployment just out of this world compared with previous recessions. We have had a lot of recovery. And at this point, we have better recovery than every recession since 1957. But there is one recession where it wasn't better recovery. So there's still a lot of room to move in terms of getting back to normal in terms of the job market. And typically the Fed likes to wait 3 to 6 months after full employment or a return to pre-recession employment numbers in order to start raising rates. So that is one piece of information that we'll take into consideration, because right now what people are asking is, when is the Fed going to stop buying bonds and start selling bonds that they've been buying? And we'll see. But typically also people in the market like to forecast where they think rates are going to be going, interest rates in the Fed. And one of the ways they do that is to forecast a rate hike in the Fed. And almost always they over assume that rate hikes are going to be happening sooner. So they overestimate these hikes. So that's another indicator that interest rates, at least those that are controlled by the Federal Reserve, may be lower for longer. We think perhaps until 2023. Treasury yields also are strong and a strong indicator of what the economy is thinking. And when you think about Treasury rates and yields, you may say, well, no, we just talked about the Fed. They set interest rates and, case closed. But that isn't the case, because we haven't had an increase in interest rates from the Federal Reserve this year, but we have had an increase in interest rates from bonds in general. And that is the market taking into consideration this inflation cycle that we have seen. They tend to price that in very quickly, more quickly than you're going to see it in the headlines and call your financial advisor and discuss it. So we had some tightening and some increase in interest rates earlier in the year. That would be an indicator of, a very strong kind of opinion about where growth is going to be going forward. And we've certainly seen inflation as well. And so we think that even though the Fed probably won't be raising interest rates, that bond yields are not likely to go lower and maybe going slightly higher. If you look at the chart on the right, where we talk about increased inflation, increasing yields on stocks, you can see, first of all, current inflation is the little tan diamond, and navy, or current inflation is the bar, and the tan diamond is inflation a year ago. And, that's like the first quarter after COVID hits. It's stunning, the difference between today and a year ago. And that is that volatility that I was describing. So you have two things. The Fed is very accommodative. They want low rates. The market's like, you know what? Maybe bondholders deserve to get paid a little bit more for the risks they're taking in borrowing. But that's okay. So we also then have to consider some reason. So that would be an indicator, or our kind of case for perhaps higher rates would be primarily inflation. What I've seen over the last 10 years, where we've had lower and lower interest rate environments, is that there are some factors that kind of keep a lid on rates. So one of the, and this matters if you're a bondholder, this matters if you're looking to get a mortgage. There's a lot of reasons it matters. It's a benefit for borrowers, and if you are retiring and expecting to clip your coupons from your bonds to pay the bills in retirement, then you're being punished. But there's a lot of demand around the world for US bonds, because US bonds, and you can see in the chart on the left, the dark line is the US, Japan and Germany, as kind of a proxy for Europe, is the blue and the tan. US bonds yield more. So when bond interest rates go up in the United States, then there are ready buyers overseas that say, hey, we're getting paid nothing or a negative yield in Germany's case. I would like to buy some US bonds. Additionally, the Federal Reserve is just gobbling up every bond they can get their hands on. And that's not going to lead to higher rates. If you have a strong buyer and demand for bonds, that means rates stay low potentially. And then, as a percent of the gross domestic product, the rest of the world has a huge percent of their GDP is owned by their central bank. Less so for the US, which may be surprising to you. But that is another factor that's just going to keep global interest rates lower. When you're asking why the heck is the economy running, certainly there's some outside forces, and I think it starts with the Fed. But Alexa will talk to you about how that impacts our stock outlook. It's all very fascinating. There's so much going on. But we're going to get right into how it impacts your investments from here.
Perfect. And get a picture of my bowl first. So the equity side, it's an interesting spot to be in because we're sitting in the middle of our strongest bull market of this duration in the U.S. history. We're up 90% from where we were sitting last March. And while that seems great, you do have a lot of investors that are kind of worried on the upside, like there's nowhere else to go. I know yesterday in our investment committee meeting, we talked about the couple months after March last year when we saw that recovery so fast, and then there were people saying it can't come back this fast, and just looking what they would have missed out on if they would have pulled back last July. So while it's good to be where we are, we do still think there's more growth on the equity side, and there's 4 reasons that we still have confidence in the equities market. So the first one Melissa did talk about, but it's the earnings. For 2021, we're looking to be up 45%. So the chart on the left shows the last 20 years. Melissa went back to the 50s, but we have not seen that in a very long time. And on top of that, the estimates for the year just keep getting pushed higher. So that dark blue in the middle, we started at $165. Into June, it's at $190. And the Raymond James analysts, they're actually targeting about $200 for the year. So the growth is crazy. And when we look at increasing the estimates, that's not just for this year. That light blue in the middle is 2022, and the yellow is 2023. So that's a great sign, and it's very unheard of to have these huge growth numbers. Historically, the 15-year average is to be adjusted down, rather than this year we're looking at being adjusted up 15%. So the analysts start out the year, very optimistic, and then they have to end up dialing back the expectations, whereas this year they have really gone the other way. So that's a big positive for the equity side there. The second one is just the economic environment. So we're looking for the economy to grow 6 or 7% this year, and for 2022 they're thinking about 3%. The first chart shows when we are at 6%, what the market typically returns, so small double digits, and then the blue diamond shows the percentage. So 80% of the time we're seeing positive returns when that's where the growth is. So it's a good indicator for that as well. And then the third one just is equities versus bonds, which we know where interest rates are right now. And that line at the bottom shows when it's below that line, bonds are relatively more attractive. And when it's above, it's the equities kind of time to shine there. So definitely relative to bonds, we're looking more attractive. And then the last reason is shareholder friendly activities are increasing, and that just drives the equities forward. Corporations right now are holding on to a lot of cash. We're very close to all-time highs there. And when they have all of this cash, they have 2 options. They either put it into their business or they push it out to us. So that's from buybacks. That second chart shows just a big pop in the buybacks that corporations have been doing. And then the third chart is very interesting to me, and it shows the dividend increases in the dark blue. So the first quarter of this year, 119 companies in the S&P 500 have increased their dividends, and only 3 have cut their dividends. And when we look back to last year, quarter 2, 47 had cut and 39 had increased. So everything is just pointing positive for the US, and a lot of it is kind of coming out of the COVID of last year, but all positive things on the equity side. And then just a quick note that within the equities, we do have a long-term bias towards the US and just our ability to bounce back and recover from this. Short term, there may be relative outperformance from the foreign side, but if we look at the first chart, this shows the decline we saw in the blue dots from COVID, and the dark blue is where we are right now. So the US on the far left, we dropped, but as of the first quarter, we're almost fully back, recovered. And once we have the numbers for Q2, we may be the first developed country to fully rebound from that. So lots of good news on that side.
All right, and thanks, Alexa, for that. And I'm going to break down, I know Melissa mentioned a little bit about when we're talking about why we're optimistic on growth and why some of these numbers are even being revised upwards on the growth of GDP has to do with continual spending, government spending, specifically in the form of infrastructure and social program spending. So I want to just break that down a little bit. There were some headlines today, as Melissa mentioned, with some bipartisan support for some of these, which is always good news. But either way, whether it's through bipartisan bills that are passed or whether it is through reconciliation, which is an option in the fall, we do believe that there will be a rather large package on infrastructure and social spending by the end of this year, if not early next year. And so we'll be, and maybe by the end of the day, we don't know, but we'll keep an eye on that. What I do want to talk about is one, our analyst at Raymond James, Ed Mills, does believe it's going to be slightly less. So the initial proposed package was about 4 trillion in spending. We're looking closer to probably 2 to 3 trillion in spending, with an estimated 1 trillion in deficit spending. And how that's broken down, the most likely to pass areas would be funding for water, electricity, broadband, roads, bridges. And then when you get into manufacturing, really focusing on areas that are going to secure our ability to remain competitive with China. That's going to be a huge area where we can get bipartisan support. And then if you look at the blue area, that kind of spending as far as the American Families Plan with childcare, paid leave, and education spending is going to be a huge area as well. So again, we do not know exactly how this is going to break down and how it's going to be passed, whether it's going to have that bipartisan support, which it looks like today, at least the headlines are suggesting it could, or whether it'll be in smaller packages that are passed. But we do know that there is going to be a large amount of spending in the form of infrastructure. And we've also seen, if we look at the next slide here, some of that has already come through in the form of the child tax credit and the American Rescue Plan. And in fact, some people have already seen that hit their bank accounts because this not only has there been an increase in the child tax credit from previous years. So it used to be $2,000 per child for children over the age of 6, is now increased to $3,000. And they increased the age from 16 to 17, the maximum age limit. But there's a large increase for children under the age of 6. The tax credit goes from $2,000 to $3,600 per child under the age of 6. And this is for all working families making up to $150,000 per couple or $112,500 for head of household or single parent households. And so that is a huge amount of an increase both in that money to offer relief to those who need it, but also it is available in monthly. It is now this month, I believe it hit for the first time, where they're going to be able to get this not just at the end of the year when they file taxes, but ongoing. So the support, as well as money that is going to be available for spending and really help boost our economy. So now to the fun part of how are we going to pay for all of this spending, right? So as I mentioned, with that, we're estimating $1 trillion in deficit spending, and the rest is going to come from tax revenue. So we've been hearing rumblings about tax rate hikes, and we don't have, again, these are forecasts. We don't have exactly what these tax rates are going to be, but If you look here on the right-hand side, we have the current corporate tax rate of 21%, top marginal rate of 37%, and the current capital gains rate of 23.8%. Now, the proposal column of 28% for corporate and up to 43.4% for capital gains rate, that'll take your breath away. I know it takes mine, but if we look at the forecast rates, which I will mention, this particular slide we use from Goldman Sachs investment research, but Raymond James Investment Research is also forecasting lower than these proposed rates that we're seeing. So we're looking at potentially a corporate tax rate of 25% and then a capital gains rate of closer to 28%. And the reason for this lower rate than the proposed rate is really just reportedly moderate Democrats are even uneasy with raising the rates quite so high, and support for that increase, as well as the revenue that needs to be met in order to fund some of these programs, does not need to be quite as high as those proposed rates. But the bottom line here is that we do feel that while the once these rates are announced, and especially if they are retroactive, in the case of the corporate rates, there could be some short-term influence on the market. So momentum reversals, if you will. However, we do think that those are going to be short-term. And then with those fundamentals again, and the earnings estimates that we're talking about, the historical earning estimates, we do feel that those are going to really outweigh the impact of those tax increases. And if you see historically equity trends on the left-hand side, when we do have where we have had capital gains tax increases in the past, usually we do see that impact the S&P 6 months leading up to that rate hike. But then again, afterwards, we're seeing in the light blue bars, afterwards, 6 months after that rate hike, an increase in the market. So that again, there could be some short-term change in the momentum, but ultimately long-term, we do see that not having a drastic effect. On the right-hand side, you'll see very similar estimates for earnings per share as the Raymond James analysts have for 2022. You're looking at a base case of 212 with that statutory rate hike increase of 25%. You're looking at taking it down to 202 for 2022. And to put that in perspective, their estimate for 2021 is 193 earnings per share for the S&P 500. So we're still looking at historically high earnings per share, and those fundamentals, again, driving and really outweighing any kind of impact that the tax increases would have on that market performance. So if we want to look at how it may affect any of those tax proposals, again, they're not, we're not sure exactly what they're going to ultimately be. We do have a little value add for you. Anybody that has registered for this webinar in advance, or you're joining us live today on July 28th, you will receive a copy of this along with the replay link when it's available later this week. If you're watching the replay and you would like us to email this to you, please do email melissa@pearlplan.com. And what this is it is something you can go through for your individual case and see how these tax changes may affect you. So you're going to take into consideration your age, your dependents, your contributions to retirement plans, your earnings, and everything else, and really kind of see what areas may have an impact on your personal situation. So certainly, if you're a client of ours, you can call us and we can help, excuse me, walk you through that. But if you would like to have this resource and you're listening to the replay, just shoot us an email and we will get it to you. As we wrap it up today, I do just want to mention, while most of our presentation today has been really positive, both on the economy and our outlook for equities, we do have to talk about sort of headwinds on potential for the market. And just overall, we want to make sure that everybody realizes that we may, while we still have positive growth, we want to make sure that everybody's expectations for that growth, we may have to have, I guess, lower expectations of return, since we did have quite a nice last year, or year to date even, right? So if we look at even on the institutional side, expectations returns on the left-hand graph there, their forecast, and this is looking at pension funds. So their forecasts are down from, in 2000, they were looking at a return of 9.4% per year for their portfolios, and now their expectations going forward are 6.2%. And the reasons for that, they're looking at lower bond yields, lower dividend yields, and then just slower overall economic growth longer term, so 5 to 10 years out. So again, while our presentation so far is really focused on a lot of this peak economic growth, peak economic earnings, we do feel that we are either at or reaching this quarter a lot of those peaks. So peak reopenings, right, from the COVID economy, really once we hit those, being that the market is always forward looking, a lot of that is already baked into the market performance. We do still see earnings as well as economic growth going forward, but we're not going to have the same expectation of the same type of return going forward. Still positive, but keeping in mind that we will, as we see headlines, potentially see more volatility with those headlines. And also, again, that long-term performance may not be quite as what we've seen over the last few years. Now, one last part that we want to touch on here, we've had some calls and some clients in our review meetings asking about some of the meme stocks and cryptocurrencies. And by meme stocks, if you have followed anything from the Reddit and the Wall Street Bets section of Reddit in the last year, seen on the news or probably in your Twitter or Facebook feeds, different stocks that have been driven up by social media and such, there have been some returns to be had for sure. But what I want to point out is just the volatility. So when people ask, should I own these areas of the market? Should I be buying them? A couple things to point out. One, if you look at the graph on the left here with that big green line that goes straight up, you'll see that it would have been great if you owned them before before that line went up, but mostly when they became on your radar, which you can see underneath, there's a little Google trend interest. It corresponds, that line went up when the Google interest went up in those stocks, that basket of meme stocks, right? So you would have seen a 1,700% increase had you bought them prior to everybody talking about them, right? Had you bought them at the peak, which is when most people probably bought them, you would have seen an 88% loss there between that peak and that red line down there. And keep in mind, you can only lose 100%. So an 88% decline in that basket of stocks is quite volatile. Now you see it did come back, but in order to make up that 88% loss in that basket of meme stocks and cryptocurrencies, you would have needed to see a 750% positive return just to break even. So what I'm pointing out here is, should you own them? If you want to own them, you have to be prepared to lose almost all of your investment and be okay with it. So I don't know many of our clients that feel that way, but if that is you, that would be my advice if you're going to own a small portion of it maybe. But what I want to compare it to is over on the right-hand side, you'll see there's like what looks like a flat boring line. And that's just in perspective because it's to the same scale as the chart on the, now I'm getting my left and right confused here, on the other side. So it is a 60-40, a 70-30, or an 80-20 portfolio, which we would consider a diversified portfolio, which a majority of our clients fall under. And so if you're looking at the return over that same time period, you'll see they actually stack up on top of each other because, again, that scale is just so huge of that ups and downs and the volatility in the other chart. But in fact, year to date, that 70-30 portfolio is has a return of about 10%. And then over the downside, over this time period, the greatest downside would have been about just under negative 40%. So there is some volatility there, but much more palatable and much more something that the average investor would tolerate ups and downs in. So it's not something just that we want to reiterate to our clients that we are, when it comes to some of the stuff you see, and it looks like it's really having good returns and you're interested in potentially owning them, that we want to look at the long-term investor and really being able to stay invested and have that lower volatility over time so that you really, again, can stay the course. So with that, I'm going to pass it back over to Melissa for questions, and she'll remind you how to ask them.
Sure. So it's pretty simple. Send an email to melissa@pearlplan.com. I would welcome questions, and I'll be checking that right now. But I think Melissa wrapped up in an area that a couple areas, what could go wrong, and also why don't I just go gamble with my money in cryptocurrency or meme stocks? Those are some really important reminders. I love talking about trends and where we see the market going, but do not misconstrue our constructive approach to the market and also our observations on the market and the economy with a kind of prediction on the market. So what we know and what my experience, almost a quarter century of investing and seeing a lot of different market environments, is that process and discipline is an investor's best friend. And understanding what you need and how you approach investments, and then developing a process around that can live in a strong economic period and investment period, which ironically is here, right smack dab in the middle of a pandemic, which keeps going, or when the economy completely seems to stop in March of 2020. An investment process that is built around your risk and around diversification and is disciplined and doesn't sell everything on a bad day or go on a spending spree on a good day, is how we've been able to coach clients through their financial lives and into retirement. Also, don't gamble with your investment story. There could be a place for some fun money, but don't throw everything away on somebody's trends or memes. We've seen that before in the .com era. We saw that in the housing crisis during the Great Recession. And so a lot of lessons learned, and we know there are a lot of lessons yet to be learned. But we love being along for the ride with you, and we really appreciate the opportunity to work with so many of you and communicate with others. So a couple action steps as I'm watching to see if there are any questions. One, feel free, we've got a podcast. Alexa and Melissa just recorded an episode together recently, so we're getting Alexa into the rotation as well. But 52 Pearls Weekly Money Wisdom Podcast is available on Spotify. And we know we have a lot of friends on the call today, but if you're not signed up for our newsletter, please let us know and we'll add you to the list at pearlplan.com. And if you have any specific questions or conversations that you'd like to discuss, please don't hesitate to reach out to us and let us know. This is a look at our contact information. Melissa, myself and Alexa are in the Dexter office, and Melissa Fradenburg is in our Grosse Pointe office, but all of our contact details are available at pearlplan.com. So with that, I don't see any questions and answers. Anything we forgot? If not, I'm going to sign off. I will tell you that we're going to have another investment call in October. So we'll look forward to seeing what has changed and what new things we can talk about then. And I know we'll be talking about year-end, to any tax changes and things like that as well. Alexa, Melissa, anything I missed?
No, definitely be talking about taxes.
Well, thanks so much for joining us and have a great day. Don't hesitate to reach out if you have any follow-up.
Thank you.